Can you hear me now?
Got you, Andy. How are you?
Great. It's very kind of you to have me on your show, Dale. It's nice to be here. Weather's pretty cold here in England today, but how?
Andy, let me just, I didn't have you set up as a panelist. Now you could, oh, now you should be able to
Okay.
talk. There we go. Okay. Well, I believe it was
Dale.
Chris Carolyn mentioned you in my last interview with him.
Dale,
you guys share? Huh?
Why don't we get him set up with his screen as well?
Yeah.
Because I have to jump on a meeting to make sure that everything's okay before I go.
So, Andy, there's a green button, share screen, drop-down menu.
I just need you. It's just stopping me from sharing screen. Right. Okay, we have it now.
Now you got it.
We've got it now, and I'm just going to try and get this PowerPoint.
It's coming up.
Perfect.
Thank you, Steve.
Thank you. Enjoy.
Okay, and we see your PowerPoint up there, Andy.
How about that? Do you see that, folks?
Yeah, we've got it. And, I just want to make a quick introduction. Andy is the author of the Market Timing Report and 0 Hour. I'd like to hear about 0 Hour. And he's also a board member for the Foundation for the Study of Cycles in GAN. And gosh, I remember that being around a long time ago during days like Peter Eliades and who were the founders again of that that foundation.
Right. Well, yeah, we just reformed. The foundation went through a bit of a quiet period. It was originally founded by Edward Dewey back in the 1940s.
Okay. Dewey.
Yeah, and the idea was to see if if the depression could have been prevented if they discovered any cycles. And of course, we're just going through the same thing right now, 90 years on, and that's one of the things I'm going to talk to you about. But yeah, we've seen Peter Eliades is actually going to be doing a presentation for us. We're going to have our summit on the 22nd of July for a few days. Sorry, on the 22nd of June. It's a non-profit. Everybody's turning up for free. We got some big names: Jake Bernstein, Peter Eliades, Bill Sarubi, Richard Smith, McClellan, Sherman McClellan, Hirsch. A lot of big names. So
you're missing one.
Yeah, Larry Williams as well. So
yeah, you're missing one though.
We're missing you, sir.
Yeah, that's right, Pinkert. Well-known lunatic, Andy. All right. So anyway, I don't want to take up any more time. I want you to go right to your work. A lot of people have a hard time wrapping their head around W.D. Gann's work. So I really respect people that I know it takes a lot of time, a lot of study to be able to implement his strategies if you can uncover them and use a Gann wheel. And I'm interested on your approach of cycles. So I'm going to shut up now, Andy.
Okay, Dale. Well, what we'll do is, as it's the first time you very kindly had me on the show, I'm just going to give you guys an overview of these bigger cycles and see how they came together and how we were able to anticipate this crash. And we mentioned 0 Hour, the name of the book we wrote a couple of years ago, forecasting this, and that's exactly where we're at. But let me build it up for you. And folks, I know a lot of you are primarily sort of short-term or intraday traders, but I hope you find this pretty interesting. And there's a lot of information here. So I genuinely believe that we're in the most critical time period of our generation, if not this century. And I think this is, what we're seeing is a once-in-a-lifetime event. Just a quick note, if I disappear, Dale, I'll be back in 2 minutes. We're having internet outages here in England, and it's not because I'm just going off to listen to a few riffs of Stairway to Heaven.
Okay, buddy.
And much as that is one of my all-time top 5. Right. It's an educational webinar, so we've got to say that sitting here in England. But what I am going to say, and if you stay with this, and I hope you do, by the end of this, you will know how to forecast the big market crises. I'll show you some of the trading techniques I use. I know a lot of you are very experienced traders, so I'll apologize right now because I'm sure you got much better stuff than we have. But anyway, here's 30 years of my work. And most of the world feels that markets are random and events are random and you can't time them. A lot of them are driven by fundamental news and therefore they can't be predicted. But I beg to differ. And let me just go into this a bit more detail. And really, in order to master market and business cycles, we look back at history. And here, this is where it gets cool. You get to see some mathematical order. And markets and history repeat in the same way as human behavioral cycles repeat. So let's give you a quick, let's give you a teaser, right? So I want to show you, this is what we're going to lead up to, and we'll look at what's going on with I was listening to Steve there talking about the dollar index. I have some interesting stuff on that towards the back end of this. But here's a macro forecasting system. This is what we've developed. And what I want to show you is where you see these spikes in the market. These are predictive. So we get these ahead of time. They're not volume. And this is what we've created from our modeling system here. And we get future spikes showing where future turns are likely to be. And, you can mark these in your diary. We'll revisit this slide a bit later. But late, this year, October 2020, we're seeing a cycle. That's going to be a potential reversal. Mid-January 2021 and late November 2021. There's just 3 points there that I want to share with you already. And you can see we had a big spike warning there back in February. So this is part of our predictive system. And I'm going to show you a lot more about that.
Could I just interject one question? Do you, beforehand, Andy, have a bias as to whether these turning points are going to be highs or lows, or do you have to wait for near that time period and just know that it's an inflection point, but at this time you don't know what it will be, a high or a low?
Great question, Dale. Basically in the old days, I would have a view on it, and then I'd usually be wrong. So what we say, these inflection points that we're looking at, I'll just bring that slide back up, these spikes, we know to expect something. And 90 to 95% of the time, the reversals, every now and then we get an acceleration. And actually, on the daily cycles, we did see an acceleration on Friday with the non-farms and everything. So, and what we do, and I'll talk a bit more about this, is we combine it with other techniques like commitment of traders data and seasonality.
Okay. All right.
That's a great question though, Dale. But just in case you've got any followers who are non-believers of cycles, goodness gracious, in case
not mine.
So just in case, let me ease you guys in gently. And you might be familiar with the years of the decade. And what we're basically saying is there's a guy called Edgar Lawrence Smith who wrote a book in 1939. And sorry, I'm going to go back in history. I'm kind of apologizing, but I'm not sorry that I'm apologizing. Stay with it. It'll be worth your while. This guy in 1939 wrote a book examining the years of the Dow, and he only had 45 years of data at this point. And he found that years ending in 3, 7, and 0, or 10, and sometimes 6 were often down years. And don't worry, I'll show you a chart in a minute. And years ending in 5, 8, and 9 are the most bullish years. And his research said this was down to weather, sunspots, radiation, and all this affects optimism and pessimism on humans. And here it is in visual form. So what we're saying is year ending in 0, certainly if we looked at February, March, April this year, we had a big down. I'm not convinced this whole thing's over yet. These two are the more bearish years of the decade. Years ending in 7, pretty much every year ending in 7, apart from 2017 and the last 100 years has been bearish. But also, you can see years ending in 5 have a big up move as well. And of course, years ending in 8 and 9, that was the big run up we had on the S&P and the indices back into the beginning of this year. So
and the 2008 and 9,
yeah,
and the 1999 top.
Absolutely.
Just thought I'd reinforce it.
No, absolutely. And actually, whilst we're doing that, so we took this, people are familiar with the 10-year cycle. I did a bit of research in the 100-year cycle, and you'll see that coming up. But the last 5 years of every century have had 5-year bull markets. So from 1795 to 1800, 1895 to 1900, and 1995 to 2000. If you want to be running for president, you want to get your great grandkids to run for president the last term of the century. They're going to be sitting on a great bull market. So that's
interesting.
That. Yeah. But now you might not be so familiar with this. The real secret is in the super long-term cycles, and it's about knowing where to look. And what I've been doing here with my team is we created all these crises matrices, and we put down every historical event. And we have a bunch of these, and we can see patterns unfolding, and that's how we kind of hone this down. And if any of you have seen the market timing report, you can see how we do the geopolitical prediction as well. But let me start off with the 72-year cycle. And, why the 72-year cycle? Well, you've all heard of the 1929 crash. if we add 72 years to 1929, that takes us to 2001. And, the market's topped out in 2000. So pretty close, give it a year, give it a few weeks and months. But we got this pretty clear cycle. And you got to look at the broad brush cycles, and I'll show you how we fine tune it then. But, if you were sitting in 1929 and, Gann predicted this, and I think he did this on the basis that if you go back 72 years from 1929, you get to the 1857 panic, which was huge. And we'll look at that in a moment. But both Britain and Europe, as well as America, had big financial panics. So for those of you, this is like being common news now. We were showing people this over the last few years, forewarning them. But, most people will be familiar with this chart now where the Dow came, made a high at 386 back there on the 3rd of September, 1929, and came down 90%. 1857, very few people know about this, but the market came down 62%. So, basically made a Fibonacci retracement there, pullback. And this was basically due to a whole series of things, basically the railroad boom and bust at that point as well.
And it rallied all the way through the Civil War. Interesting.
So, that's right. Yeah, actually, there we go. Pretty strong. Well, So the Civil War started here, didn't it? And it rallied all the way up through there. And actually, I will tell you why in a minute. Okay. I hadn't thought of that like that. I was going to talk about that in context of commodities, but Dale, that's a great point. Yeah. Let's just moved to 2000 to 2001, and the market started running out of energy. We saw the end of the tech boom there, and what we saw was that they came down 40% really as we headed into the new millennium there. And that's effectively the 72-year cycle kicking in. So if you're paying attention and you want to write this down for your grandkids, 2073, that's 2001 plus 72 years. That's the next one, and I kid you not. That is going to be like clockwork. So make a note of that one. Now, we double up the 72-year cycle and we get 144 years. And let's take a look at this. And you hit it right on the nail there with the Civil War. But let's go back 300 years to, from now to the South Sea bubble in 1720. So this is a boom and bust. At the same time, we had the Mississippi land crisis. And if you guys have ever studied this, a guy called John Law, who was a Scotsman, went over to France, convinced them they should unpeg their currency from the gold standard. He made it available to everybody, and he started selling people swampland down in the Mississippi and, New Orleans. Basically, that was a boom and bust. So there were two big boom and busts 300 years ago this year. We'll come back to that one. Add 144 years, Dale, and we get to 1864, and we see, we're now well into the Civil War, and we see a huge commodity boom. The price of cotton was trading at 3 cents a pound as we ran into the Civil War. But by the 23rd of August, 1864, cotton was trading at $1.69. So it had gone up, $1.89. It had gone up almost 60-fold. And Gann wrote that on some of his charts. So that's where we picked that up from. So it was a 60-fold increase. Why? Quite simply, because it was demand and supply. Suddenly, there's nobody left tilling the soils, creating cotton. Right. Everybody's out fighting the war. And what do you need to fight a war? You got to look smart. You got to have a uniform. So the demand for cotton goes right up. Supply goes down. And everything goes up 60-fold. And it wasn't just cotton. Wheat made huge, you can look at Gann's old charts. You're obviously familiar, and several of your readers, followers are, your listeners are. But wheat had a big boom around about then as well. And I think it's probably this commodity boom that answers the point you made, that the stock market went all the way up through that time, Dale.
Yeah, okay.
So, let's add another 144 years, and this was the commodity boom that we saw in 2008, and it was the first of a couple of, we got a double top 2 years later, as it were, more than a double top, we got a secondary high, and this was due to partly the dollar being weak. I mean, I remember, happy days for us Brits, $2.11 to the pound,
Yeah, I remember.
Yeah. You know, I was spending all my time in America. In fact, actually, as it happened, I spent so much time in America, I ended up marrying an American the next year. So, so that was
congratulations.
Yeah, she's over here now. So anyway, that's the 144-year cycle, and really, I know this is a long way ahead, but we talked about 2073. 2080 will be the half cycle, adding 72, and then you can put this one down for your great grandkids. But this is how it works. It really does work this easily. So now I want to introduce you to the 90-year cycle. This is really what we're all about this year. And it's a very strong cycle in commodities as well. And more importantly, if we take the 1929 crash and we added 90 years, that took us to 2019. And, we got the high just 6 weeks into 2020. So when you got to factor a bit of a tolerance on these yearly cycles.
Right.
That's why we've been writing 0 hour. We were talking about a big crash coming in. And it wasn't just the 90-year cycle. We already looked at this chart. I showed this one to you. But we got to go back another 90 years to 1839, and 1837 to 1842 saw what was known as the Long Depression. And this was because money was really cheap heading up here into 1837. And there was a lot of speculation around Chicago and the Great Lakes. Land prices were very cheap, and they were building canals like crazy to get the agricultural products out into the Great Lakes and then up the St. Lawrence Seaway and getting them out internationally. So, credit was cheap, and we got this massive boom, and we went to bust, So what we're seeing is we're getting 2 90-year cycles or 180-year cycle, and that's why I was getting concerned. I said this, you talked about 0 hour that I wrote with my friend Harry Dent. I was showing him this stuff back in 2008, and, the more we worked on it, the more we realized we had to collaborate on this. So we've got this cycle.
Andy, just bringing up cheap credit back there in that time zone, I believe the credit is as cheap now as it was back then. So, I mean, we're talking about 200 years rates. It's been almost 200 years since credit has been this cheap. Is that correct?
I would have to look that up to be absolutely correct, but I am absolutely sure you are right, Dale. There is no doubt about that. Yeah.
Okay. And then the repercussions from that.
Yeah.
Okay.
We'll look at, actually, I think coming up next, we'll look at those as well. So let's just.
I was only a kid then.
So yeah, you and me both, buddy.
Yeah.
So, but the halfway cycle then is the 45-year cycle, and we take 1839 because it's the precise point, and we look at 1884, and in 1884 we got this pullback here. It wasn't a huge pullback, but it was still 20-30%, I believe. And that really was all to do with gold, and Britain had a gold crisis going on there, and they were coming on and off the pound as they were messing around with the gold standard, and a bunch of gold went missing. I think some ships sunk as well. But here's the cool bit. Let's take 1929 and add 45 years, and you get the Middle Eastern oil crisis, the OPEC oil crisis, right?
Yeah. Yeah.
We had a huge recession. Now, you and I were definitely there, and I remember it very clearly here in Britain. We went on to a 3-day week. We had power cuts, power outages, and, we had no power at night and so on.
Buttons, whip inflation now.
Yeah, absolutely. And you can see this is a logarithmic chart here. You can see the magnitude of the 29 crash, though. And when we look at this logarithmically, it's like just a blip, isn't it?
Yeah.
But this was a major point, an inflection point, and we move on 45 years. We get this big sort of crash we got February, March. And what do we get in March? Oil crisis.
Yeah.
Regular as clockwork, this stuff. So
I never thought I'd see a negative number on a futures contract.
Oh, that was crazy, wasn't it? Yeah, I was kind of like, how do we manage the risk of this?
That was the one, first time in my lifetime.
Yeah, that was just crazy. I mean, I was just watching the screens, and we just kept well clear. I mean, it was kind of like, this has got to be a no-brainer. Let's do it. But hey, we don't want to be caught on the wrong side of this if we're wrong, if we miss something. So we just kept well clear that day. So now we talked about credit cycles. Let's look at the 100-year cycle. And folks, this is the home run, as it were. This is the last bit of this. So, you can get ready, and we'll look at things in a bit more detail. Well, the 100-year cycle, Back in 2008, I was over in South Beach. Actually, this is where I first met Harry. I was also with, there were 40 of us, and there were some big names. And for some reason, I was there. I just minimal knowledge in cycles, but Jim Rogers was there, Bob Proctor was there, Tony Robbins was there, a few people. And they were throwing ideas around saying nobody could have predicted this. And I quietly said to one of the guys, well, you know, the 2007, we're 100 years on from the rich man's panic, right? And you mentioned credit, crises. That's exactly what happened. 1907 was caused by it was called the Knickerbocker crisis. In fact, we'll look at the charts in a minute. So I won't run too far ahead. And then you take the half points of these and you get 1857. So do you see how this is coming in the 150-year cycle as well as it was in the 72-year cycle? So
so you look for the confluence of a lot of cycles all pointing towards one time zone.
And that's what those histograms are. They're confluence cycles. Yeah.
Okay. Mm-hmm.
And so 1907, we'll talk about these in a minute, 1957, 2007. So, 2057 is going to be another one. As I said, the confluence in 1857 is important. But back in 2006, I was over in Cincinnati talking to a private client group, and I said, look, this is coming up. You might just want to protect your wealth. And there were runs on banks in all these cases, and they were going, that can't happen. We're in the modern age. We're in the 2000s, dude. Yeah. Well, in England, we had people in a line outside the Northern Rock Bank trying to get the money out, and that bank folded, and several banks folded globally. So let's just dig in a bit more detail. So this is the 2007 global financial crisis, and the market came down, as you know, just over 50%, 54%. And 1907, this was the rich man's panic, the Knickerbocker crisis. The markets actually came down 80%, and it was due to the rapid withdrawal of credit. And, the government brought in J.P. Morgan personally to help bail this out. And what happened in 2007, we definitely heard the name J.P. Morgan quite a bit, didn't we?
Yes.
So, yeah. But here's the thing. Here's the trick. Very few people know that in 1807, the American market collapsed 80%. Why? Because America was trying to influence the Napoleonic Wars in Europe. And they figured that if America stopped all trade with Europe and England, it would bring the European economies to a halt. Well, in theory, that was probably going to work, but it wasn't. It didn't bring them to a halt before it brought the American economy to a halt. So
interesting. So this was the first example in American history of trade policies like embargoes and tariffs creating a disaster.
You know what? I think it could well be. Yeah, I never thought of it like that. Okay. Dale, that's a very cool point because I've done.
It's like we, started this as well last year.
Yeah.
It rhymes. It's not an embargo act, but trade friction anyway.
Trade friction and trade wars. It's all part of the same thing. And we've follows my report. I do write about the cycles on this, and probably outside the scope of this, but the Hong Kong cycles came in with China has very many cycles coming together. That's why you've seen it in the news last year. Last year was 30 years on from Tiananmen Square and 60 years on from the Tibetan uprising, as well as 120. So you get 120, 60, and 30 all coming together. That's why China was in the spotlight and is in the spotlight. They were all international relations issues in every one of those. So but that's a little bit outside the scope of what I've prepared. I mean, if you guys like this, just another shout. And but let's just go into the 50-year points of this. And I want to show you that 1957 had a recession and a big pullback. 57, it wasn't a crash per se. So this is the 50-year cycle. 1907 plus 50, gave us this. If you go back to 1807, add 50, you get 1857 that we've talked about both in the 72-year cycle and this cycle. But 1957 saw this pullback because basically everybody that could afford a refrigerator now had one. Everybody that could afford a television now had one. Everybody that could afford an automobile now had one. And so manufacturing just ran out of steam. That's basically what it was. It was saturation, as it were.
Okay.
And here's the 1957 chart. It's down only down 20%, but it's sufficiently, over a year. It's a reasonable move,
Yes.
1857. I just wanted to recap this one. this boom and bust was because it was all to do with railroad bonds. You know, railroad was as developed as it was going to be for that time period. And over in Cincinnati, the Ohio Life Insurance and Trust failed, creating the Knickerbocker. This was just the big crisis then. And this was the biggest banking failure in American history to date. And it was greater than what happened in the global financial crisis. Over half the banks in America went bankrupt in 1857. So you can see now these patterns are repeating very clearly. And just, in case anybody else is a non-believer, this one just freaked me out. I have to say I wasn't seriously trading in 87, but I do remember the 87 crash. And basically what we saw there was this. The highs came in the same week. So these are 50 years apart, these two patterns. We get we see the high there, we see the low to the day, we see a similar pattern. So no, nothing's perfect. You use the phrase rhyming, and that's really what we see. There's often clues to get the odds on our side. So let me this first part of the presentation now, and I'll zoom in. But the reason we're in such a critical point right now is that, we're 90 years on from the 29 crash. That's 2019. So we've overlapped in. It's 45 years on from the 74 low and the oil crisis. Now, this is, I didn't mention this, but 2019 saw a big oil panic, and that went into 2020. What did we see? Like you talked about negative oil prices for, front month delivery. 2020 is also, so not, if you look at the 1929 crash, it came down in bits, and there was a big acceleration. There was a collapse in 1930. We talked about the 300-year cycles from the Mississippi land crisis and the South Sea bubble. Now, these two are really interesting. But 1819 to 1820 saw land panics, as did 1920. Well, what are we seeing? We're not so much seeing a land panic right now, but we're seeing people moving out of commercial real estate. And here we are on Zoom, everybody's doing stuff on Zoom. Also, we're 72 years on from the Middle East, the creation of Israel, which created a bit of geopolitical friction, and 144 years on from Britain and Egypt having a crisis. So I think we are going into some war cycles soon, and that's something that I've written about recently, again, outside the scope of today. So the real challenge we face is that, from history, we can see some very clear cycles, but, do you ever have a stop that's a year wide, in time, let alone price? No. So you get in too early, the account runs out. Get in too late, you miss the boat. And so this is very important to whether your business and financial investments are going to be successful. So what we did was we created the system of these histograms, which I've already, alluded to. And these are all cycle sets. And you mentioned confluence, and that's exactly where we get cycle confluences. And where they peak in the future, you can see that there's a potential for a change in trend. And let me give you this example. This is just going back 2014, just to illustrate the point. This was the biggest spike we ever saw. This was all in real time. These are predictive. These are there before the market unfolds, as it were. These were existing here, but we didn't have this bit of the market. But this spike alerted us to something big happening. And of course, we've been in this sort of uptrend on the euro for over a year. So this is kind of getting quite exciting. And you could argue that, there's a bit of trend line resistance coming in. But the monthly cycle was giving us a huge warning. And then we looked at the weekly cycles, and around about the same time, we're seeing a huge spike in the weekly cycles as well. And then you can see how the monthly cycle and weekly cycles are pretty close together. So this puts us on long-term alert, or, over a window of a few weeks. And then we're looking for something, ideally, if they all lined up together, which they very rarely do, but you get, a real gift. So we were looking for something big to happen. And we found a daily cycle here. And as it happened, that then turned out to be the day of the high.
Yeah.
And, you can see here, this here ties up with this low and so on. So I'm just trying to illustrate our system, and we'll look at some of the topical stuff coming up in a minute. Same thing on crude oil monthly cycles back 2007, 2008, 2007, wasn't it? Yeah, that's right. With these here. And the same again here, you can see these things. These are older charts. I just use older charts because otherwise people want to focus on what's happening now. And we'll talk about that in a minute. In fact, let's talk about it right now. We mentioned these, so you're probably getting the hang of these now. And, you might want to make a note of these or whatever. But this is just some pretty clear points that are already showing up that we've marked down in our diaries. So what do? We use these to protect trending positions. We don't immediately take the reverse position because we've got to be able to quantify the risk. But late October 2020, I'm seeing that as a significant point. Then mid-January 2021 and late November 2021. Taking this a bit further, if I just tell you a little bit about the market timing report, is that okay with you, Dale? I'm just going to,
sure.
Yeah. So, this is what we show to people. The benefits are really that, look, you guys are all, pretty much professional traders, but this is about taking everything into your own hands and being responsible. So, having timing helps make, your decision-making process and, rather than taking tips from your broker. And what we do in the report is it's a monthly publication where we cover the S&P 500, gold, crude, dollar index, euro, and I've added Bitcoin just using the GBTC, the proxy. And on the cover, I put up either one or two dates, which I believe to be the most important dates of the month, and they will usually apply to the S&P. And we started this back in 2014. We were using this, we developed this system in the early 2000s, and we were trading it ourselves very happily, and also working with a handful of hedge funds and just selling them this information. And then people kept saying, "Hey, we want to access this." So that's why we created the report. And these are the arrows are the turning points we called on the cover, and the little ones are the smaller cycles we called inside. So we're not perfect, but we've got pretty much most. I mean, we probably missed that high there, but we've called pretty much every other one since then. And I like putting a lot of geopolitical commentary in because it just gets interesting for people. And also, we can get an idea of what's happening in the world and so on. Once we get into each individual section on the market, we have a red section, which basically shows you the longer term cycle. So this is like the weekly cycles that I showed you. Mm-hmm. And if you're an investor rather than a trader, so you're a portfolio manager or whatever, these are the key dates you need to look at. And you can ignore the rest of it. But also, I like looking at decennial patterns. You saw the 10-year patterns, and I'm going to show you a very interesting one on the dollar index in a minute. But basically, we look for matches, and we quite often see pattern matches between the 10, 20, and 30-year cycles going back. Also, in our system that we've created, we find that there are certain days in certain markets. Here is crude oil. I mean, look at this, 28th and 29th of September since 1984. They have very high probability up days on the 28th and 29th of September. So, if we're running up into that, it's probably going to go up through those days if we don't get any other indications. And that just gives us a little bit of a tailwind. You can't trade on it alone. And of course, the most important thing is our proprietary profit finding histograms, as we call them. And these are the turning point dates. So we give the daily dates there, the weekly and the monthly ones are in the red. Also, I look at a lot of seasonality. So if we can see, for example, gold tends to make a low around about the 14th of September over the last 30 years and a high around about the 28th. So that's regular seasonality. But if we got one of our timing dates here and we're making a low, say on the 10th over the timing date, we might want to get in a few days earlier. Equally, if there isn't a timing date, we might not be seeing that working this year. So it just, again, gets the odds on our side. None of this is pure information by itself. And of course, with Fibonacci levels, if it's hitting a price level, then, and there's no time cycle, it'll probably go to the next Fibonacci level and vice versa. But just to show you, this example was just showing some people last year. I just kept it in here. Gold was running down last May. And we had a very important weekly cycle as well as a bunch of daily cycles. And we got the breakout. At this time, everybody was very bearish on gold. They were saying it was going right down down to 1,000. But we had these strong cycles, and that's where we got the breakout. So we managed to get in there, and that worked pretty well using this. And also, some of our followers they didn't have a trading system once we, started marketing it as a retail product. So we've created a trading course, and we show people how to use, different systems and, our particular nuances. And basically when they tie up with us with a time cycle, it's a time to potentially take profit. And when they don't, so, why not this cycle or this cycle? And that's kind of how we use that.
How do you manage risk, Andrew? Because these are based upon time rather than price. Do you just use some type of monetary money stop, 1%, 2% risk, or do you have to give it 2 days either side of the dates?
No,
so I'm curious how you manage risk on these
I tell you what, hold me to that one, and I'll show you a great example just later on the deck. Yeah.
Okay.
And yeah, because that's really important. You can't trade off time alone. Well, you can, but your account might run down.
Yeah.
So, and in fact, this here is one of I use a lot of Andrew's pitchforks for managing risk, and we've put this in our course, and we have a particular way of using them. But so what we will do is, for example, here, this is a profit target. I know when I've watched your show, people use pitchforks. So you'd come out here, but we got a retest here. And, basically that retest, we would then have a downsloper in or some other parameter to take that short trade. And we had a clear time cycle coming up. This is an older example, but this is an example of traded both up and down. And what we did here was we had the Fibonacci level at the median line, so we knew we could get back in. And I'll show you how we use these pitchforks in a moment to manage risk. But yeah, that is absolutely critical. And so, what we're saying is with the market timing, it shows us when to get in and, gets the odds on our side. Again, doubling of ranges with gold. We tend to be position traders, and, we do manage a professional portfolio. And we'll look for the bigger patterns. This is a great example of just doubling of the range, giving us the high. But, like Crocodile Dundee says, you can live on it. But this is even better. This pitchfork going back 45 years gave us the exact high there. And in fact, you asked about managing the risk. What we'll do is we'll put a pitchfork in here. And once the trend is confirmed, we'll then put a risk reward ratio based on, this is too big in this case, because this is a weekly chart running 45 years. But once we've established a target using some other techniques, we calculate the risk reward ratio and then put the stop in. But as you guys all know, there is only one thing you trade, and that's price. Time is helpful, but it's only price that makes you money. Here we had some very big cycles in April on gold, big monthly cycles, and we haven't taken the April highs out. And again, that's that same pitchfork, and we put some action reaction lines in, and that's why we're still fighting this out. We came all the way back to the top of this line on Friday when we got the big sell-off in gold. So we're still fighting this line. If we sit here, we might head back on up, but there was some strong cycles, and the commitment of traders data was pretty bearish till recently on gold. And then we kind of put in an overview of the daily turning points. And the beauty of this grid is, if you see everything coming together on the same set of days, there's going to be some big economic news, Here we're just seeing, like just crude oil on the 27th of September. This is a couple of years ago, I think. But where you see all these things together, that's a big economic story breaking.
Like, do you have cycles for this Wednesday with the Fed?
A
lot of dots, different confluence of markets.
Yeah, actually, we'll do that in a second, actually. Yeah, okay. So that's, yeah. So what we say is, you can use this with fundamentals and exactly what you've just said there, protecting your trending positions, Fibonacci levels, pitchforks, and cut data. And let me, I got a few more minutes to run through this. Basically, we use this for our fund management, and it gives you additional tools. I've spoken about, sorry, this is part of a presentation that we give to other people as well. I'm not here to sell you stuff, but what we did was, I was working with a very well-known US billionaire who is mad on cycles. We have an NDA. I can't tell you who he is, but he's very successful. You'll pretty much all have heard of him. And basically, that's why we created this report. And then people didn't know how to use the time cycle, so we created a trading course. And the idea with the trading course is really what we've been talking about, how to protect risk and calculate objectives and how to use timing with it. So I'm just going to run through that because I want to get to some better stuff. So what we do is we use this together with seasonality and COT reports, which we just call the timing system. The smart money system. And, for example, right now, for the Aussie dollar, May's generally pretty bullish. I know we got a big run up, but take a look. I want you to take a look at this. The Aussie dollar seasonally since 1988 tends to make highs round about the end of the first week, then sell off. Well, let's just bear that in mind, exactly about what you talked about coming up next few days. So that's the first point I want you to look at there. We also have a weighted average there that we have a little proprietary thing there that gives us a bit of an advantage. I'm going to gloss over that slide. But I don't know if you guys tend to use the commitment of traders data very much?
Yeah, many look at it, yes.
Yeah. So what we find here is just a quick overview. The commercials are the people, they're the hedgers, the people that drive it. And when they get to extremes, the market, this is our platform we've created, and they tend to sell in uptrends because they're producers, as it were. So, here the red line shows the commercial selling as the market goes up, and they get to this extreme high line that we have. And, basically that's where the market makes a high. But what we have is created our own index, and that can flatline, and we don't know when something's going to change. It can flatline for a long time, for a couple of years or whatever. This market went sideways. But what we then found was that if we applied our timing cycles, we knew that would be the week to look there. And of course, sure enough, that was the time to look, and that was the time to look for getting short. So we would look to manage our risk on the short side there as the market came on down, you see. So that's how we use these timing cycles in there. And what we do is we put all the data, we just download it from the CFTC, and this gives us ideas of what areas are changing and so on. And we look for real extremes. This one's just a few weeks old, but we were seeing extremes in palladium there, and they highlight in color, with the below 5% or above 95%. And these are markets that we'll zoom into then. So I just wanted to share that. That's one of the things we combined with this. And now we put our track record there up on the website as well, so everybody can see it, whether we're right or wrong. Now, this is what I want to share with you, and I'm going to run up to the dollar index. But here's some long-term cycles. Here's the monthly cycles on copper. And we see this huge spike all the way here in September 2021. So I'm starting to think maybe this could be the beginning, that we might run down. I know copper's been all over the place the last week or two, but we might run down and see a sort of end of recession type low around about September 2021. But in any event, whichever way copper's moving into that, it's more than likely going to reverse. So that's that. Gold, a couple of longer term turning points, and I'm going to show you a shorter term one. Late August to beginning of September 2020, we're seeing a turn, and also mid-February 2021. So again, these are these spikes that are predictive. But here's a very strong cycle that I've just put in the latest report. The week ending 24th of July, take a look at this. This is a big spike. We got that high on the spike there, that big high that got us a low, and we got just the beginning of a trend there. So not only have we got the daily cycle, the weekly cycles for the week ending 24th July, we also have daily cycles on the 21st to 22nd July. We'll fine tune them as we get into the beginning of July. So I think there's going to be a very big inflection there. Is it going to be a high? Is it going to be a low? I don't know. What I would do is that if I haven't, we don't have no positions in gold right now. It's just too volatile. But I would be certainly protecting my position in that if I did have one. Dollar index, February 2021. So, we're seeing some interesting things. Here we go. Gold, February 2021. Dollar index, February 2021. So there's something big cooking for next February already. So that's that one. And right now, this is what I show you. We have a very big spike for the dollar index this week ending 12th June. Again, same deal. You can see the reversals on previous spikes. It's not perfect. Sometimes we miss them. You can argue that was a correct call. And they don't get them all. We have to run more than one set to catch them. But first point, warning, this week there is a big cycle. Now, look at this. The decennial patterns. Go back 20 years. That was the 7th of June. So that was the equivalent of yesterday being a Sunday. That's today. We started seeing a change in trend. We've been coming down basically the last few days on the dollar index, and I saw Steve talking about that. But look at this. From here, we start trending up, okay? Now, I don't know if we're going to follow the same thing, but let's just flip back 10 years and 30 years and look at this. The 10-year cycle made an exact high there, 7th, 8th June, and the 30-year cycle starts a big decline. And these guys then maintain this pattern all the way into August, right? Yeah. So, and go back to this one. This maintains this pattern all the way up into September. This suggests that whatever happens in the next couple of days, we're going to see a trend developing that might well run for a few weeks.
From your lips, amen to having a trend in the dollar. That would be good news for all of us Forex traders. So thank you on that, Andy.
Me too. I would love to see a trend. And this is the setup right now. This is the sort of the cash rally. The futures pattern is slightly different on the June dollar index. But this is the pitchfork we were using. And this, once we got a rejection of here, we actually got this one here. We went short there because we could protect the risk off this. We use so you're asking about how we manage the risk. Yeah, we don't trade on time. We got to have somewhere to put a stop, a hard stop, together with a target and a risk reward ratio. But you see, right now we're off the 786 retracement on the daily chart, and this is going to be. If I'd have loved to have seen it come down to here. If it come down to here, made a double bottom right on the median line, that would be a gift because we could then put the opposite pitchfork in and point upwards. But I think we are on high alert. We're on red alert now. If you've got a position in the dollar index, if it's more than just an intraday position, if you've been position trading it, then you probably want to protect that. And I think there's some big changes afoot this week. And I think once it shakes out, we're going to head into a trend.
Thank you for sharing a timely cycle, Andy. Well, thanks very much.
I know you guys are shorter term. I just never been on before. I wanted to give
I try and be patient, but sometimes I can't wait for 100-year cycles.
I know it's tricky, isn't it?
Because,
just pop out to the diner and you miss it as well. That's the crazy thing.
I think Rip Van Winkle could trade those. He just goes to sleep for a little while. So I really appreciate the work.
Right.
And we're getting some excellent feedback for you, Andy. You're going to have probably some new subscribers, at least some new followers. We should follow this guy, Edith said. I hope he's on Twitter. Then someone shared your Twitter.
Yeah, we're on Twitter. Yes, right.
You have a sympathetic smile. That's because you know how hard it is to trade. There was a guess that billionaire was Ray Dalio. And thank you, everyone. Everyone's appreciative of your presentation. And like it or not, Andy, you're now my trading warrior brother.
I love that. I'm going to put on Stairway to Heaven soon.
All right. All right. Andy, really, I'm glad that we finally were able to do this. I'd like to keep in touch with you. I'll DM you later and we'll get another date for you. I want to wish you and your subscribers and all the people you teach that pips rain down from heaven on you guys on your key dates, and really was great having a conversation. Thanks for edifying our community today.
Well, thank you so much for having me on your show. It's been my pleasure. I'm very honored, and if you like it, I look forward to seeing you all again soon, guys. And I'm on Twitter there, Andrew Pancholi, and come sign up at markettimingreport.com. There's a bunch of free stuff there as well. Okay.
Thank you, Andy. Everyone, Andy Pancholi, and that's a wrap for us. We'll see everyone for Turnaround Tuesday. Remember, whether it's cycles or anything else, don't just count your pips, count your blessings. Adios. See everyone tomorrow.